There's an old saying in trading that most people hear, but very few actually understand. There are old traders, and there are bold traders, but there are very few old, bold traders. At first, it sounds like a clever quote, something you nod at and move on. But if you stay in the markets long enough, you realize this isn't a saying, it's a warning. Because nearly everyone who blows up an account didn't do it because they were stupid. They didn't do it because they didn't understand charts. They didn't do it because they lacked indicators, strategies, or setups. They did it because they traded too big. Most people come into trading with the same belief. If I want big money, I need to take big risks. That belief feels logical. It feels aggressive. It feels powerful. And it destroys more traders than any bad strategy ever could. We are wired to think this way. In sports, in business, in life. Swing harder, push more, bet on yourself. But the market doesn't reward bravery. It rewards survival. And that's where most traders get it completely wrong. When someone hears risk only 1 to 2% per trade, their first reaction is usually frustration. They think, that's too slow, that's boring. I didn't get into trading to make small money. If I wanted small returns, I'd just invest. What they don't realize is this. Trading small isn't about making less money. It's about not losing the right to keep playing. Because once you lose that right, the game is over. Let's say you're risking 10% of your account on each trade. You feel confident. You trust your setup. You know the trade will work. Then reality hits. 5 losing trades in a row, which is completely normal in trading, and your account is nearly cut in half. Not just your balance, your confidence, your patience, your discipline, everything changes. You're no longer thinking like a trader. You're thinking like someone who's desperate to recover. Now compare that to a trader risking 1% per trade. 5 losses? They're down 5%. Annoying, yes. Painful, a little. Account destroying? Not even close. One trader is now fighting to survive. The other is still calmly hunting for opportunities. That difference right there is everything. Because trading is not about winning the next trade. It's about being mentally and financially stable enough to take the next 100 trades. And here's the part most people never calculate. If you lose 50% of your account, you don't need a 50% gain to recover. You need 100%. You have to double what's left just to get back to zero. But if you lose 5%, you need 5% to recover. One trader needs a miracle. The other needs a normal week. This is the mathematical reality aggressive traders ignore. Big losses don't just hurt, they permanently tilt the odds against you. And yet, people still trade big. Why? Because aggressive trading feels good at first. When you win a big trade risking big size, your brain floods with dopamine. You feel smart, you feel powerful, you feel like you've cracked the code. And the market lets you feel that just long enough to trap you. Because the same size that gives you that high also gives you panic when things go wrong. And things always go wrong eventually. The market doesn't care how confident you are. It doesn't care how clean your setup looked. It doesn't care how badly you want it. It only cares about math. And math is brutal to traders who bet too big. In this video, we're going to break down exactly why trading small is not just safer, but actually more profitable over time. We'll talk about why aggressive traders almost always self-destruct, the psychological trap that turns small losses into account killers, real trader stories that prove this isn't theory, and why professionals risk less, not more. Because once you truly understand this, you stop chasing wins and you start building wealth.
Here's something most traders don't want to hear, but absolutely need to understand. The market doesn't beat you. Your own brain does. And position sizing is the weapon it uses against you. When you trade too big, you're no longer operating from logic or probability. You're operating from biology. Let's break that down. Every time you place a trade, your brain anticipates a reward. If the trade moves in your favor, especially when you're risking big, your brain releases dopamine. Dopamine isn't just the feel-good chemical, it's the reinforcement chemical. It tells your brain, do this again. So when a trader risks 8%, 10%, or 15% on a trade and it wins, something dangerous happens. They don't just make money, they associate oversized risk with success. That's how traders start believing they've figured it out. They think, I knew it. My analysis is better than most. I can size up now. This is how accounts are set up for destruction long before they actually blow up. Because dopamine doesn't care about statistics. It doesn't care about drawdowns. It doesn't care about probability. It only cares about repeating the behavior that produced pleasure. Now let's talk about the other side of the equation, loss. When a trade goes against you, your brain experiences pain. And here's the key part most traders don't understand. The pain of losing is about twice as powerful as the pleasure of winning. This is called loss aversion. It's hardwired into human survival psychology. Back in primitive times, a loss could mean death, so our brains evolved to treat loss as an emergency. Now combine that with oversized position sizing. When you're risking 10% per trade, a losing trade doesn't feel like feedback. It feels like a threat. Your heart rate increases, your breathing changes, your focus narrows. This is no longer trading. This is fight or flight. And in fight or flight mode, rational thinking shuts down. That's when traders move stop losses, hold losing positions just a bit longer, enter trades they normally wouldn't, size up to get it back. This is not a discipline problem. It's a biological response to perceived danger. The market has put you under stress, and your brain is trying to escape the pain. This is how revenge trading begins. Not because you're emotional, not because you're weak, but because your position size is forcing your brain into survival mode. Now compare this to trading small. When you risk 1% per trade, your brain barely reacts. A loss is information, not trauma. You don't panic, you don't spiral, you don't feel the urge to immediately fix the damage. You stay neutral, and neutrality is where good trading lives. This is why professional traders obsess over risk control more than entries. They understand something retail traders ignore. You can't trade well if your nervous system is under attack. Your strategy might be solid, your setups might be clean, your analysis might be correct, but none of that matters if your brain is hijacked by fear or greed. Here's the cruel irony. Aggressive traders often think they're confident, but confidence built on big size is fake confidence. It only exists when the trade is winning. The moment price turns against them, that confidence evaporates and panic takes its place. Real confidence comes from knowing no single trade can hurt me. That belief changes everything. You stop needing trades to work. You stop hoping. You stop forcing outcomes. You execute. And execution, not prediction, is what makes traders profitable. This is why traders who trade small actually improve faster. They get clean feedback. Losses don't traumatize them, so they can review objectively. Wins don't intoxicate them, so they don't overestimate themselves. They learn faster because they're emotionally stable. Big size delays learning because every loss feels personal. Every win feels like proof of genius, and neither of those are true. The market doesn't reward intelligence. It rewards consistency. And consistency only exists when your emotions are under control. Now let me tell you about two traders who started at the same time. Same capital, same knowledge, same market, but radically different outcomes. And the only difference, how much they risked per trade.
Let me tell you about two traders. I won't use their real names, but we'll call them Trader A and Trader B. They both started trading around the same time. Both were smart. Both were disciplined, at least at the beginning. Both had spent months watching the same YouTube channels, reading the same books, studying the same strategies. And both started with $25,000. On paper, they were identical. Same market, same setups, same win rate, same risk-to-reward ratios. If you looked at their journals in the first few weeks, you wouldn't be able to tell them apart. The difference came down to one decision: position size. Trader A wanted results, fast. He was tired of his job, tired of the commute, tired of trading feeling like practice.
He didn't want trading to be a side project. He wanted it to be an escape. So he risked 5% per trade. In his mind, it made sense. If I'm right, I want it to matter. I don't have time to grow slowly. I believe in my setups. Trader B saw things differently. He didn't love his job, but he didn't hate it either. He wasn't in a rush. He just wanted consistency. So he risked 1.5% per trade. Trader A called it boring money, said he'd never get anywhere trading that small. Trader B didn't argue. He just kept trading. 6 months later, the difference was impossible to ignore. Trader A had some great weeks early on, big green days, screenshots worth posting. But then came a bad month. Nothing unusual, just a normal losing streak. 5 losses in a row. Because of his position size, those 5 losses crushed his account. $25,000 dropped to $8,400. And the real damage wasn't the money, it was what happened next. Trader A stopped sleeping properly. He checked charts constantly, even when markets were closed. He snapped at his girlfriend over small things. He felt angry, embarrassed, and ashamed. Every trade now felt like life or death. He wasn't trading to execute a strategy anymore. He was trading to escape pain. Trader B's experience was completely different. His worst drawdown over those 6 months? Around 11%. Annoying, but manageable. He still slept fine, he still exercised, he still had a life outside the charts. And while nothing dramatic happened in his account, something important did. It grew. 6 months in, Trader B's account was at $31,200. No viral screenshots, no massive wins, just steady progress. Now, fast forward 1 year. Trader A had blown up what was left of his account, trying to recover. He told people trading was too stressful, too risky, probably rigged against retail traders anyway. He quit. Trader B is still trading today, 5 years later. His account crossed 6 figures long ago. He eventually quit his job, not out of desperation, but confidence. Same intelligence, same strategy, same market, different position sizing, different lives. This is the part nobody talks about. Aggressive trading doesn't just damage your account, it damages your relationships, your health, your identity. Because when you trade big, every loss feels like a personal failure. Every drawdown feels like proof you're not good enough. And over time, that stress bleeds into everything. Safe trading doesn't just protect your money, it protects your mind. And that protection compounds, because a calm trader makes better decisions. Better decisions lead to better execution. Better execution leads to consistent results. Now let's talk about what happens when markets go completely insane. Because if trading big is dangerous in normal conditions, it's deadly in chaos.
Most traders build confidence in calm markets. Nice trends, predictable pullbacks, clean entries. That's where aggressive traders feel unstoppable. But markets don't stay calm forever. And when chaos arrives, it doesn't just test your strategy, it tests your position size. Let's go back to March 2020. COVID hit, and markets didn't just drop, they exploded. Stocks were moving 20%, 30%, even 40% in a single day. Circuit breakers were triggered repeatedly. Liquidity vanished, spreads widened, stops stopped working the way traders expected. Volatility became uncontrollable. If you were risking 10% per trade during that period and you were on the wrong side of a move, you didn't lose 10%. You lost 30 to 40% of your entire account in hours. Not because you were wrong, but because the market moved too fast. Stops got slipped. Orders didn't fill. Risk models failed. I watched traders get wiped out in real time. People who thought they were disciplined. People who thought they had solid risk management. Their mistake wasn't bad analysis. Their mistake was assuming volatility would respect their position size. It never does. Now compare that to traders risking 1% per trade. They took hits too. Nobody escaped unscathed. But a 30% adverse move on a 1% position is a 3% account loss. Painful? Yes. Terminal? No. They survived. And survival is everything. Because here's the brutal truth most traders miss. The biggest opportunities come immediately after chaos. The COVID crash lasted weeks. The recovery lasted years. The traders who survived the crash were perfectly positioned to profit from the rebound. Some had the best months of their entire careers. The aggressive traders? They were already gone. Accounts blown, capital wiped out, watching from the sidelines while the market printed money. Volatility doesn't care about your conviction. It doesn't care about how confident you are. It eats oversized positions for breakfast. And this isn't a one-time event. Every major market opportunity follows instability. 2008 financial crisis, 2020 COVID crash, 2022 inflation shock, AI-driven volatility in 2023. Every time, the same pattern repeats. Safe traders survive the storm. Aggressive traders disappear right before the opportunity. This is why professional traders are obsessed with not dying. Let me be very clear about this. Real professionals do not trade big. Hedge funds managing billions often risk less than 1% per position. Some go as low as 0.25%. These people have teams of analysts, advanced algorithms, real-time data feeds, decades of experience, and they still trade small. Why? Because they understand something retail traders don't want to accept. Staying in the game is more important than winning any single trade. Paul Tudor Jones, one of the greatest traders of all time, has a simple rule. If a position makes you uncomfortable, get out. That rule only works if your position size isn't terrifying. When you're risking 10% per trade, every position is uncomfortable. So you don't cut losses, you hold and hope. And hope is the most expensive strategy in trading. Here's another cost most traders ignore. When you take a massive loss, you don't just lose money, you lose time. Time recovering, time rebuilding, time not compounding. Lose 50% of your account and it can take years to recover, even if you're good. Years of missed opportunities, years of stalled growth. That lost time is something you can never buy back. Small losses cost money. Big losses cost years of your life. This is why trading small isn't conservative, it's strategic. It's how you stay alive long enough to catch the moves that actually matter. And now let's address the argument every aggressive trader makes. But what about the big winners?
Every aggressive trader has the same argument. They say, what if I catch a massive winner? What if I hit a 10R trade? What if this is the one that changes everything? On the surface, it sounds logical. Risk 1% and hit a 10-to-1 trade, you make 10%. Nice, but not life-changing. Risk 10% and hit the same trade, you double your account. That sounds incredible. That sounds like freedom. And that fantasy is exactly what destroys traders. Because here's the reality no one wants to accept. You will never survive long enough to catch that trade. To catch a true home run trade, you need to be in the market for years. You need to take hundreds, sometimes thousands of trades. And during that journey, you will experience losing streaks. Not because you're bad, but because that's how probability works. Even elite traders with solid edges go through stretches of 5, 6, or even 10 losses in a row. Now, do the math. At 10% risk per trade, a normal losing streak eliminates your account before you ever reach that mythical 10R winner. The aggressive trader isn't unlucky, they're mathematically eliminated. Safe traders survive the losing streaks, which means they're still around when the market finally delivers those rare explosive moves. Big winners don't reward courage, they reward survivors. Let me tell you a real story that burned this lesson into my memory. There was a guy in a trading Discord I used to be part of. Smart trader, good setups, solid analysis. He started with $50,000. For about 2 months, he was on fire. Account grew to $71,000. Screenshots everywhere, confidence through the roof. Then the tone changed. He started saying things like, when you know, you know. I'm sizing up when the setup is obvious.
He began risking 8% per trade. Then came a rough patch, 5 losses in a row. Perfectly normal. His account dropped to $45,000. This is where things got ugly. He panicked, started posting about needing to make it back. He sized up to 15% per trade. 3 more losses. Account dropped to $26,000. Now, desperation took over. He abandoned his strategy, started taking random trades, risked 25% per trade on pure emotion. Within 6 weeks of his peak at $71,000, his account was under $3,000. One final message in the Discord, something about trading being rigged, something about retail traders never winning. Then he disappeared. Here's the painful part. He wasn't bad at trading. His edge was real, but none of that mattered once the death spiral began. This is the pattern I've seen over and over again. Big size to big loss to emotional trading to bigger size to account death. Safe traders never enter this spiral. They can't, because no single loss is devastating enough to trigger panic. When you know a trade can't hurt you, you don't need it to work. That freedom changes everything. You don't move stops. You don't force trades. You don't pray. You execute. And execution is where profitability lives. Aggressive traders think they're maximizing opportunity. In reality, they're shortening their lifespan in the market. They're chasing a fantasy that statistically wipes them out long before it pays off. Now let's talk about the hidden advantage safe traders have, something that compounds over time and separates real professionals from gamblers.
There's a moment every trader remembers. That moment when a trade goes against them and they freeze. They stare at the screen. They hesitate. They start bargaining with the market. Just bounce a little. Let me at least get out closer to break even. It'll turn. That moment has nothing to do with strategy. It has everything to do with position size. When you're trading too big, every trade carries emotional weight. You don't just have money on the line. You have your confidence, your self-image, your future plans. So you stop trading the market. You start trading your fear. Safe traders don't experience this because they know something aggressive traders don't. No single trade matters. That knowledge is freedom. When you risk 1% per trade, you don't need the trade to work. You don't feel attached to it. If it stops out, you log it and move on. That detachment produces something rare in trading: objectivity. Your entries improve because you're not forcing trades. Your exits improve because you're not emotionally invested. Your stop losses stay where they're supposed to be, not moved out of hope. This is why 2 traders with the same strategy get wildly different results. One is emotionally neutral, the other is emotionally compromised. And over time, that difference compounds. Every time you execute your plan correctly, you build trust in yourself. That trust becomes confidence, real confidence. Not the fragile confidence that disappears after one loss, but steady, grounded confidence. Aggressive traders never build this. Even when they win, they reinforce bad habits. The win feels intense, relieving, stressful. So the next trade carries the same tension. They're trapped in a cycle where every trade feels like a test of worth. Safe traders experience something different. Wins feel calm. Losses feel manageable. There's no emotional whiplash, and that emotional stability allows for growth. Here's something that doesn't get talked about enough. Discipline is not willpower, it's environment. If your position size puts you under stress, discipline will eventually fail. Not because you're weak, but because stress degrades decision-making. Safe trading removes stress at the source. It doesn't ask you to be more disciplined. It makes discipline automatic. This is why professional traders look boring. They're not chasing excitement. They're protecting clarity. Clarity lets them see opportunities others miss. Because while aggressive traders are recovering from emotional damage, safe traders are compounding. And this psychological edge grows over time.
After a year, the difference is noticeable. After 5 years, it's massive. One trader is calm, consistent, and confident. The other is anxious, reactive, and exhausted. Same markets, same opportunities, different inner worlds. Now let's bring this back to the greatest long-term wealth builder of all time, because this principle doesn't just apply to trading, it applies to money itself.
There's a reason the wealthiest market participant in history never talks about big wins. Warren Buffett has been investing for over 70 years. 7 decades. Let that sink in. During that time, markets crashed, wars happened, currencies collapsed, entire industries disappeared, and yet he kept compounding. Not because he was always right, but because he never destroyed himself. Buffett famously has 2 rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Most people laugh at that. They think it's simplistic. But look deeper. He's not saying never have a losing year. He's saying never put yourself in a position where one mistake ends the game. His worst drawdown, about 50%, happened during the 2008 financial crisis when the entire global financial system was on the verge of collapse. Most years, his drawdowns are small, single digits. Why? Because Buffett isn't swinging for home runs. He's protecting his ability to stay invested. And staying invested is what allows compounding to work. Compounding is not exciting in the beginning. It's boring. It feels slow. But after enough time, it becomes unstoppable. And compounding only works if you don't reset the clock. Every time you blow up an account, you reset time back to 0. You don't just lose money, you lose years of compounding. Let's make this painfully real. Imagine 2 traders. Both are decent, not geniuses, just consistent. Trader 1 risks small, survives, and compounds at an average of 20% per year. Trader 2 trades aggressively and blows up every couple of years, then restarts. After 10 years, Trader 1 isn't just ahead, they're in a different universe. Because compounding isn't linear, it's exponential. The biggest mistake traders make is focusing on how much they can make this month instead of how long they can stay profitable. Time is the real edge. And aggressive trading steals time. Here's the part that hurts the most. When you take a massive loss, even if you recover financially, you rarely recover psychologically. You become cautious in the wrong moments, aggressive in the wrong moments, hesitant when you should act, overconfident when you shouldn't. That damage lingers. Safe traders avoid this trauma. They build confidence slowly, the right way. And over time, that confidence becomes unshakable. Now let's talk about opportunity cost, because this is the invisible tax aggressive traders pay. Every month you spend rebuilding is a month you're not compounding, a month you miss the best trades, a month where capital should be working but isn't. Think about the biggest market moves of the last decade: post-COVID recovery, AI-driven tech surge, commodity supercycles. These didn't wait for traders to get their accounts back. They happened while people were sidelined, broke, burned out, frustrated. Safe traders were there, capital ready, mind clear. That's the advantage nobody posts screenshots about. The quiet trader isn't exciting, but they're present, and presence is everything in markets. Now, let's talk about someone who learned this lesson the hardest way possible. Someone smart, analytical, highly disciplined, and still nearly destroyed himself by trading too big. His name is Marcus.
Marcus was the kind of guy everyone respected. Engineer by profession, analytical, methodical, detail-oriented. The type of person you'd expect to do well in trading. He didn't rush into it. He spent nearly 2 years studying before placing real money on the line. Charts, risk-reward, backtesting, journaling. He did everything right. When he finally started trading, he funded his account with $75,000, his entire savings. Not borrowed money, not inheritance, everything he had. And at first, it worked. Marcus was good. Not flashy, but solid. He identified clean setups, followed his strategy, and stayed disciplined. Within 8 months, his account grew to $104,000. Nothing crazy, but real progress. Then something subtle changed.
Marcus started thinking in dollars instead of percentages. A 1% risk used to feel responsible. Now it felt small. He'd look at a trade and think, if this works, I only make 1,000? With my accuracy, I should be earning more. So he sized up from 1% to 3%. Still reasonable, he told himself. Then came a losing streak. Nothing dramatic, 3 losses in a row. But because of the increased size, the emotional impact was different. He felt pressure, so he increased size again, just slightly, 5%. This setup is clean. The odds are in my favor. I've done the math. The next trade, lost. Now the account was down significantly, and something cracked. Marcus didn't panic outwardly. He didn't rage trade. He did something more dangerous. He became rigid. He refused to take small losses. He widened stops. He gave trades room. He held losers because selling meant admitting he was wrong. Within 3 months, his account dropped from $104,000 to $58,000, almost half gone. This is where most people expect the story to end, but it didn't. Marcus didn't quit. He doubled down. He told himself, I'm too smart for this to end here. I just need to get back to even. I can't accept losing years of savings. So he traded bigger. 10% risk. One good trade could fix everything. Except it didn't. Volatility picked up. A trade slipped past his stop. A 10% risk became a 17% loss. That single trade erased months of work. Marcus didn't sleep that night, or the next. He stopped exercising, stopped seeing friends. Every waking hour revolved around charts. He wasn't trading anymore. He was trying to undo pain. 6 weeks later, his account was under $20,000. Years of savings, gone. Here's the part Marcus told me later that stuck with me. He said, the money hurt, but what hurt more was realizing I broke my own rules. I knew better. That's the quiet tragedy of aggressive trading. It doesn't fail because people are ignorant. It fails because it overpowers intelligence. Marcus eventually stepped away, took almost a year off. When he came back, he traded with tiny size, painfully small, 0.5% per trade. It felt humiliating at first, but something amazing happened. He stopped being afraid. He followed his plan. He slept again. Today, Marcus is profitable. Not rich, not flashy, but stable. And he will never trade big again, because he learned the truth the hard way. Trading big doesn't make you successful faster. It just makes failure permanent. Now, let's bring everything together, because understanding this is useless unless you know exactly what to do instead.
At this point, the pattern should be clear. Accounts don't die because traders lack intelligence. They don't die because strategies don't work. They die because traders bet too much on being right. So let's end this with something practical. No hype, no fantasies, just a framework that actually works. Here's how real traders think about risk. They don't ask, how much can I make on this trade? They ask, how much can I lose and still be completely fine? That question alone changes everything. The professional risk framework. If you're serious about trading, not gambling, this is the structure. 0.5% to 1% risk per trade if you're learning or rebuilding. 1 to 2% risk per trade if you're consistently profitable. Never more than 2% on a single idea, no matter how perfect it looks. That's it. Not because you're scared, but because you're thinking long term. Next rule. Never increase size to recover losses. This is non-negotiable. If you're sizing up because you're down, you're no longer trading. You're reacting, and reactions are expensive. Professional traders increase size only when their equity curve is stable, their drawdown is controlled, and their execution is clean over time, never because of emotion. Your goal is not to win big. It's to stay normal. The best trades feel boring. No adrenaline, no obsession, no need to check every tick. If a trade feels intense, your size is too big. That's not intuition, that's stress. The final truth most traders learn too late. The market doesn't reward courage. It rewards patience. It rewards discipline. It rewards people who show up every day with capital and clarity. Trading small doesn't slow you down. It keeps you alive long enough for compounding to work. And compounding is ruthless, in your favor, if you let time do its job.
Most traders are trying to change their lives in a month. Professionals build wealth over years. Same market, same opportunities, different mindset. So, if you take nothing else from this video, remember this. You don't need to be right more. You don't need better setups. You don't need bigger wins. You need to stop letting one trade decide your future. Trade small, stay calm, survive. Because the traders who win aren't the bold ones. They're the ones who stayed. The market will be here tomorrow. The opportunities will come again. The only question is, will you still be here to take them?